What's going on, everybody? It's Blandon here from Mortgage HQ, and today I'm going to talk about the LVR changes and what does it actually mean for you. I'm going to give you a better understanding of exactly what is going on, and I'm going to give you some of my thoughts on what I think it means for the market. And if you stay till the end, I'm going to show you one restructured strategy that is going to help you build your portfolio faster and help you buy more properties. So a quick summary of what the LVR is actually doing right now. What does that word actually mean? LVR, loan to value ratio. It actually means smash that like button for the YouTube algorithm. Now, if I was to simplify it more, it actually means the deposit that is required to buy a property. So in the current situation, if you're trying to buy an owner-occupied property, you would need 20% deposit. And if you're looking to buy property investment, you need also just 20% deposit. And if you want to learn how to buy a property with just your equity on your property, you can watch another video that is on our channel in the description below. Now, in response to the economic impact that COVID-19 has caused, the Reserve Bank at the time released an announcement in April 2020 to say that they were going to remove all of the restrictions that they have implemented since 2015. Now, a lot of first home buyers at the time thought this meant that there was no LVR, or you could just buy a property with no deposit. In other words, borrow 100%. Unfortunately, that wasn't the case. It simply meant that whatever rules that they have implemented since 2015, they have abolished it for the time being until next year, March. So if I was to simplify it once more, there was just one change. So owner-occupied, no changes, you still need 20% deposit. If you have strong income, you can get away with 10%. And if you're buying Kiwi Build, you can just go with 5%. Now, in March 21, we are going to see that the investors will now require a 30% deposit. So they're bringing back what they have implemented in 2015. So what does this mean for the market? Back in 2015 was actually when I bought my first investment property. At the time, I had an approval using 20% deposit to buy an investment. I needed it because I need to use the rental income to service the new loan. And because I was looking for ages, the 30% rule was about to kick in, so I had to just buy something really quick because I had the fear of missing out. And so I did manage to buy something. With the new LVR rule change at the time, it actually priced out a lot of the investors that are just coming into the market. So the property purchase during that time, sort of end of 2015, early 2016, a lot of them had actually staggered on prices and the capital gains were quite limited, including my own property. So is that going to happen again this time around with the new LVR rule coming back in at 30%? Now, there are two big reasons that I don't think it's going to be the same as what happened in 2015. The first reason being interest rates. Now, back in 2015 when I bought that first property, most of the Auckland property, if you just look at the average 800K property, it's going to be cash flow negative, meaning every week you have to put money towards that property to maintain it. Today's market, we have all-time historic low interest rates. Virtually all properties are cash flow positive today. What that basically means is whatever you buy, you're going to get money in your pocket every week straight away. And so I feel there are still scope for prices to go up. And as long as these assets remain cash flow positive, it will still be attractive for a lot of property investors or investors in general with a strong equity position. The second big reason that I don't think the market is going to get affected as much this time around is to do with net migration. Now, Tony Alexander is the ex-BNZ economist. He releases a lot of articles, and a recent interview that I watched, he basically talked about the net migration being around average of 35,000 per year, meaning we have 35,000 people moving to New Zealand. That's what we would expect on a yearly basis. But before the lockdown, we basically had 91,000 net migration. Simply put, we have pretty much banked all of the people we were expecting to come next year. They have come before the lockdown. This has also caused a surge in prices in the second half of 2020 as well. And when the borders open up, I can only imagine New Zealand being a more attractive country to migrate to, and a lot of skilled professionals, I believe, will come back to New Zealand, and it's going to help the economy grow, and it's going to help us move in the right direction. With that said, I don't think the prices are going to slow down. So who is going to get affected by this new LVR rule change that they're bringing back next year? Some banks have already implemented this, and I believe very soon majority of the other banks are going to follow, and it's actually going to be fully implemented before the actual announcement date of Reserve Bank of New Zealand. So new investors are going to get priced out. People who actually need to start growing their investment nest, they're not going to have enough equity to buy an investment property. They are forced to buy in the regions if they had a bit of equity, and if they were trying to buy their first one, it's going to be a lot tougher for them. They might be stuck with just buy a property as an owner occupied. So that's going to push up the first home buyer market. And for investors with an existing portfolio, this 30% LVR rule is not going to really affect them. This is mitigated by the rising market. Just to give you an example, if I open up CoreLogic today versus when I did it earlier this year, looking at a property that I have in South Auckland and a property in Regents, both of them have risen more than 10% in valuation. And this is the value that the bank use to lend you money. So for an existing investor like myself, we're not affected a whole lot because of the rising prices, and it's a lot easier to access the equity. And we can see that is happening for majority of our clients as well. So if I can be critical, I don't think the LVR rule was well thought out. The people that they're trying to target are the existing property investors with a bigger portfolio. They shouldn't be allowed to just keep growing their portfolio really quickly. Even though it affects me, I think it's unfair because it affects the people who actually need it the most, which are the new investors who have to go back to the first home buyer market and compete in that space. And that's going to push up the first home buyers market. It's competition as well. But after all that, what could you do? What could you do today to protect yourself if you're an existing property investor? How could you set up yourself for better opportunities? So here's a quick example. If you had 3 properties, 2 investment and an owner occupied, the best thing for you to do right now is try and isolate them as much as possible so that the investment properties are at a bank that will offer you 80%. So it will look like this. And what you want to do is you want to top up these investment properties to 80% while you still can. And for the time being, you want to use this debt to repay any debt on another property. So you can use this to repay the debts on this. Now this is a freehold security, whether it is your own occupied or another investment property. If you're more established, you now have a freehold security that is going to open up more options for you, and you can utilize different property strategy like trading or even just borrowing off this property to do construction for maybe a friend that you have a development project with. And if you want real case studies and look at different property strategy, financing strategies as well, you can check out our masterclass online in the link in the description. And if you want to assess your situation just to have a better understanding of what is the best step forward, I recommend talking to a Mortgage HQ advisor, again in the link in the description below. I'll see you guys in the next video.